want to talk about the BitBonds. What they're doing is you can say, hey, let's say instead of just taking a typical treasury bond or the government, or in this case, New York City, typically we would take all the money, issue that, put it in a treasury and pay you out, you would get that. Now, this situation is you take 90% of those funds and you put them in that entity, and then 10%, say, or whatever percentage that is, you put into Bitcoin for an appreciation. All right, here's the kicker. You could lower your interest rate. So their Bitcoin Policy Institute is saying, hey, instead of paying, say, 4.5% to 5% right now on a 2-year or a 10-year, what if we gave you this loan and you could borrow at 1% to 2% interest? Now, that in and of itself is a massive significant savings. When you go from, say, 4% to 2%, that's a massive savings, especially when you're looking at over time. And you have to ask yourself, well, why would anybody do that? Well, Daniel Creech wouldn't give the government money in that situation unless you tied it to a Bitcoin bond, because guess what? I'll take a little bit of interest because however long the time frame is the bond, you're betting on the price of Bitcoin to appreciate that way. So just like a normal bond, Frank, when you get your principal and interest back, you're still going to get your principal and interest back in this situation. However, you have the upside to possibly get a gain on the Bitcoin appreciation during that time.